For the first time in a year, U.S. companies are planning to boost their payrolls and investments. The National Association for Business Economics, says these findings do indicate the recovery will be sustained into 2010. Christopher Lowe, chief economist at FTN Financial, says that's just another encouraging sign that this economy has turned the corner. He joins us now from his firm in New York with more. Chris, great to see you.
Good to see you, too.
So where do you see, or how do you see the economy, the recovery unfolding from here?
Well, I think we're going to continue to see now some pretty good news, at least for the next 6 months. I think GDP growth will be on the strong side in the fourth quarter, in the first quarter next year. We've got the double whammy of stimulus, which is really starting to hit now, and also an inventory cycle, which is just beginning to turn. And in conversations, particularly with manufacturers, it sounds like orders are coming in faster than they expected, and they're starting to get optimistic, which is great.
Well, that is all well and good, of course, but as you've probably heard, there are some concerns out there that some of the stimulus, for example, cash for clunkers, is fading out. And then you have this first-time homebuyers credit, which is more than likely, according to followers, congressional followers, not going to be extended. So, you know, could these things start to curb spending and therefore the broader recovery?
Well, yeah, absolutely. Look, there's over 20 different bits and pieces of stimulus. The first-time homebuyer tax credit was probably one of the most effective. Cash for clunkers, frankly, I have mixed feelings about. I think car sales were recovering even before that came on. It's too bad. Unfortunately, I think it's the allegations from the IRS that the program is just rife with fraud from top to bottom that means it can't be extended. But we have lots of other stimulus. There's hundreds of billions of dollars being spent. And of course, the Fed has kept rates almost at 0%, which is also stimulative. And then we have turned the corner on the inventory cycle. And that, I think, will be the most important driver for the next 2 quarters.
Where is the demand going to come from? We have durable goods orders coming out a little bit later this week. And this really has been the challenge for the economy, this excess slack. And companies, as you know, are making numbers by cost cutting versus top line growth. One of my earlier guests pointed to that and said that's just going to add to the unemployment problem on the other side of the coin.
Well, it does, but it doesn't. I think when you look at payrolls today compared to, say, the early months of the 01 recovery, the big difference is that the employment cuts we've already seen are so much deeper because, of course, the recession was longer and it was deeper. I don't think there's a lot of cuts still to be made. And I have heard firsthand from chemical makers, from tire makers, from shipping companies that they never thought they'd be saying it, but they will be hiring. And that's because orders are starting to come in. As far as where the demand is, right now it's retail that looks like it's in the best shape as far as inventories go. That's where the inventory to sales ratio is the lowest, and that will be the driver of orders.
Will this economy see full employment in the next year to 2 years? How long is it going to take to really bring that unemployment number back down to 3-4%?
Oh, it's going to be years and years. And in fact, I don't think we get back to full employment like we had in the last business cycle at all in this business cycle. Many of the jobs that were cut are permanently gone, but that doesn't mean you don't get job growth. And we will have the kind of job growth that's consistent with sustained 1 to 2% GDP growth for the next few years. So I think the unemployment rate will stabilize in 2010 and will begin to gradually come down. But no, I don't think we get back even to 6% in this cycle.
A lot of people are also concerned not only with their jobs, but of the value of the U.S. dollar. Obviously, the dollar turning around today, perhaps people thinking the dollar's fallen too far, too fast. But what's your view? And is there a concern that the dollar globally could get so weak that international investors are just going to start tossing out international assets, and that could jeopardize the equity rally we've enjoyed here in the U.S. the last 6 months?
That, I think, is the big danger. When you look at the dollar and worry about weakness, the biggest fear is that the fear itself chases away foreign investors. We're not seeing that yet. The Treasury flows show a pretty healthy buying still, particularly of equities and corporate bonds from overseas. I think part of what's going on with the trade-weighted dollar, we've weakened a lot against G7. We have not weakened nearly as much with a broader basket of trade partners. And part of the reason is that there's a concerted effort to devalue particularly Asian currencies to keep step with the dollar. And one of the things that that does is it puts upward pressure on sterling. It puts upward pressure on the euro, the Swissy, and so on. And that's one of the reasons the dollar looks so weak if you look at a narrow basket of currencies. But look at a broad basket, trade-weighted. The dollar's down about 60% of what it was up last year. So it's really the reversal of the panic trade. Foreign investors coming in, particularly to treasuries, to hide from global turmoil. And I think you look at that broad basket, and the decline in the dollar now is starting to lose steam. We're beginning to get some stability. So I think that outlook will improve over the next couple of months.
So you seem to be okay with the dollar where it stands. You wouldn't characterize it then as a weak dollar?
No, I wouldn't care. Well, if you look at it on a multi-decade basis, absolutely, because the dollar sold off from really from 2002 to 2007, at which point it was as weak as it ever was. In 08, it was up about 21%. And again, on that broad trade-weighted basis this year, it's down about 2/3 of that. So, yeah, it's relatively weak over the last several decades, but we're not by any means at new lows. And if we stabilize here, I think it'll be okay. And I do expect it will stabilize at least near here.
Okay, and the weaker dollar, as you know, also driving up oil to around $80 a barrel again. Do you see this trend as having broader curbing implications for the economy? Or will it be a good thing in that perhaps it'll raise energy-related shares and buoy stocks?
Well, you know, I think on balance, you look at all commodities and they tend to trade with the dollar, well, in the other direction. Everything is a little more expensive in terms of raw materials. And a good illustration of that, in Europe, the CPI has fallen 4 months in a row because energy prices are going down. In the U.S., CPI inflation is up 3 of the last 4 months because energy prices are up. So that's where the dollar has the biggest impact on consumers. But I think even that negative impact is offset by price weakness in the core, away from food and energy. And the CPI year on year is still negative. So it's not the kind of thing that's going to cripple the expansion by any means.
Chris, thanks for your discussion on the economy. Appreciate it. Chris Lowe of FTN Financial.